Hey, how's it going, traders? This is going to be an introductory video for those who are just getting started in the Forex market or starting with this entire mentfx course from the beginning to basically get a full understanding of what is going on. Now, just considering it and thinking about it, if I'm going to create a mentorship course and upload videos concerning institutional order flow, how markets move, algorithmic trading, and multiple ways of trading, risk managing, and ultimately becoming a successful trader and gaining your own financial freedom trading, I thought it would be important that we start in a place where anybody that comes across my channel, whether they are experts, novices, beginners, or intermediate people who might have either dabbled a tiny bit in the Forex market or even started somewhere like me in binary options a long ass time ago, versus some people that almost know everything they can possibly know about the market and are still struggling, or people that are doing well and want to refine their strategy to the point where they are ultimately extremely sure and confident in their trading. Okay, like I said, if I'm going to start a course, or if I'm going to teach a mentorship, or if I'm going to upload videos with concepts that I at least consider are somewhat in-depth, I think it's fair to start out with a place where many traders can start to learn about what it is we're looking at and how we're trading. Okay, so we don't know exactly where everybody's starting, but this video is going to be targeted specifically at very beginner people. And what we're going to be looking at, you can skip a little bit forward if you don't want to watch this, or if you've seen a lot, is ultimately what the charts are, what it is you're trading, what's going on when we see price move up and down like this, how candles work, and then we're going to touch on a little bit about how we trade, how I trade, and talk about the importance of risk management or strategy, right? And it might be a little bit of regurgitated stuff of what you've heard before, but I'm sure there's a few hidden gems that you might be able to get out of it. And we're going to try to keep it short, but ultimately I want this to be a very good informative video for those that are getting that are new into it, that are very new to this market, and for those people that might be coming back after unfortunate events that might have happened, trying to create a living and out of doing something like this. Okay, so to start off with, we're going to get rid of all this. This is not important right now, so let's just go ahead and open up a brand new chart. Actually, we'll open up one of the majors, and we're going to get into this in a second, but ultimately what we're going to do is we're going to take a look at this, delete everything that's on it, throw in a line chart. Okay, and we're gonna leave that at this and then get into this. Okay, so the cool thing about just the entire financial world and the whole financial freedom world is that there is a big market. There are multiple markets, okay? You've probably heard of them. There are stocks, there are currencies, there are commodities, that's like oil and gold. There are indices, that's like SPY, the DAX, the NASDAQ, and there's like the soybean market. There's almost any market in the world, okay? One of the biggest and most liquid markets in the world is the financial, or in this case, the currency market, okay? There are pairs, as you can see on the side here. So this itself is TradingView. It is a platform, a charting platform, just like MetaTrader is, if you've ever seen it. And what happens is, in the charting software, you can ultimately predict, draw things on, put indicators on, right? So you can go and experiment with things like this, putting on random indicators people might have coded, seeing how price reacts at certain areas, taking buys and sells off of randomly coded, generated things. You can also be one of those traders that have just gotten into support resistance. So keep in mind, we don't trade this way here, but we are going to touch on it because this is what everyone who starts is introduced to, right? The idea of support resistance, head and shoulders holding, things like that. This is the currency market. The currency market is the most liquid, which means it has the most money traveling through it each and every single day. It's recorded to have about $5 to $6 trillion travel through it a day, right? Across all the pairs. So what's important to understand is there are some major pairs, okay? These major pairs are the following right here, okay? So the major pairs are Euro, US dollar, so that's one of the ones we have open right here. US dollar, yen, the pound to the US dollar, Australian dollar to US dollar to the Swiss franc, New Zealand dollar to the US dollar, and the US dollar and the Canadian dollar, okay? Those are the major pairs, and then all these other pairs you see here are either called minors or they're just in between, okay? Ultimately, you can trade each and every single one of them Spread, something that occurs when there aren't enough people in a market or a price is higher than the price you see on the screen, is because, you know, there's not enough supply and demand on some end of the market, which is why a lot of people prefer or like to trade things like the euro to the dollar, or gold to the dollar, or dollar to the yen, because the price movements have people getting into positions at almost every single point. Okay? So what's cool about the way we trade here institutionally is that this concept and application can apply to anything, any chart, any time frame, so that's no problem. But before we continue with that, let's continue looking at what's happening here, okay? So ultimately, as we now understand, we are on a major pair, okay? There's a lot of movement in it. There's a lot of people trading this. There's tons of money that passes through this every single day, okay? The reason for these movements up and down, as you've seen on any chart, most likely, even on stocks, is the idea of supply and demand, okay? There are people on each end buying and selling the currency. In this case, we're looking at the euro to the US dollar. There's constantly people that are buying the dollar, that are selling the euro, that are buying the euro, and that are selling the dollar. And as a result of those transactions, price likes to move up and down, okay? Now, when you think about this, you cannot limit yourself to believing or thinking that the only person that is trading this is retail. So retail is what we do ultimately. Retail is the idea of support resistance, looking at charts, trading, and trying to catch moves and making money off of the profitable moves that we make, or directional predictions or trades that we make, okay? Now, that's a big part of it. There's a lot of retail people involved in this, okay? But you also have to realize who's involved in this entire market, okay? There's not just retail. There's retail in the form of, you know, people just trading. There's also banks, smaller banks trading. Those are retail banks. Then there's institutions, which come down to investment firms, hedge funds, and other big, large money holders, institutions as well. On top of that, you have things like governments trading in these markets. You have countries or governments trading in these markets as they fluctuate their currency and try to, you know, apply bank policy, whatever it might be, to keep them within a certain area or to move them up or down, or hedge even. So as a result, you also have hedge funds in this market. Since hedging is a big thing, you have people, or you have companies, or you have wealthy individuals that are moving their money from one country to another, exporting or importing goods in a certain currency, whether it's China, France, whatever it might be. There's always an exchange that's happening. There's tourists that are constantly going to different countries. So you have all of that shown in this price here, okay? So you can't just think of this as the act of buying and selling on just a retail basis, okay? There's a lot of things that undergo the transactions that happen in this market and the ups and downs that happen in it, okay? Like if we go back to a larger chart, this is a more daily chart, right? This was the lead up to Corona, and this is when Corona hit, right? When Corona hit, there was a lot of things that were happening. There were people selling off their holdings. There were people that are hedging from other countries. There were people that were unhedging from other countries. There were people that were taking or getting rid of their dollar. People that were buying more euro, and this uncertainty is what led to, as you can see here, these huge drastic changes in volatility in price. Okay, but ultimately, what you need to understand is that all this entire chart shows is the change of the euro to the dollar. Okay, and the way you read something like this is you're trading the base currency. Okay, so no matter what currency you're looking at, if we're looking at the euro to the US dollar, when we're conducting buy or sell operations, so long and short positions on this market, we are actually buying or longing the euro, right? Or when we short it, we are shorting the euro by using the counterpart of the dollar, right? So it's very different to the idea of short selling in stocks. Well, it's similar in the sense that we short it, but there's no transaction costs like that are that insane. And it's just different. It's a different market because of how liquid and how much people are in it, and how you are ultimately trading two sides of it, since they're currencies. Okay, there are countless currencies. These are not all of them. There's even more. I just have these added onto my toolbar. DXY is the dollar index, so it's also the same thing. If you look at it, it's just gonna be a line. So by that same token that we were just talking about, if we were looking at this chart right here, so let's close all this stuff out. We don't really need it right now. If we're looking at USD CHF, the idea here is that we're trading the dollar in accordance to the Swiss franc. But when we buy this market, for instance, if we think it's going to do this and we buy it, what we're saying is the dollar is going to get stronger, right? We're buying the dollar, okay? And to put it into even easier terms, let's look at something like Euro USD and explain it in the same way before we move on to the next step. Okay, so let's say we're looking at this chart right here, and we're looking at this form, whatever it is, and everyone that's looking at this, if I ask you where do you think it's going, could have a different perception, right? That's why the market moves. First of all, some of you might be saying, oh, it's going to just continue up, I'm seeing something happen here, right? Some of you might be seeing, oh, it's hitting this, I want to see it come down. Some of you are saying, oh, maybe this was like if you're more advanced, oh, this was a Wyckoff distribution, which of course we'll see on a candle line, so you're expecting this to maybe come a little bit higher before dropping. So let's just, for instance, assume that we're going to short this, okay? For those that are new, this is a short position. When you short, you are looking for the market to come lower, and you have what we call a stop loss. So if this gets hit, you ultimately get out of the position and lose a certain amount of money. But let's consider what's happening with price right now, okay? So price is currently at 1.18642, okay? So price is currently at 1.18642. That's what it's traveling at, okay? So what that means right now is that it costs $1.18 to get 1 euro, okay? So the way you want to think about this is, if you think about this Euro USD, just put a 1 right here. Okay, so the way we think about it is it's 1 euro to $1.18, right? So if we wanted to buy a euro right now, it would cost us $1.18. Okay, so you might be already seeing how this works, but let's say we wanted to short this, right? We think it's going to come down to what area? Let's say about 16400, just to make it simple. So we think that this price is actually going to drop from here all the way down to about here at 1.16600. Just make it an easier number. Okay, so when we look at something like this, and we're anticipating a movement from this area here, which is about 1.18642, which means that at this area, at this point in time, a euro, so the way you want to think about it is put a 1 in front of the euro. 1 euro is worth $1.18642. Right? So if in the future we believe that 1 euro is going to be worth $1.16600, then we don't want to hold our euros right now because they're going to depreciate in value, right? Does that make sense? If you have 100 euros, your 100 euros are worth $118, right? You just multiply this by 100, $118. Now, if you hold on to those 100 euros for the next X amount of time, and they're going to be worth 1.16, your 100 euros that were worth $118 are now actually worth $116. So they're worth less. So how do you, quote unquote, trade this to make a profit on it? The idea is what you'll do is you'll sell off your euros and buy dollars, right? So you'll buy a ton of dollars. That way you're mitigating against this risk. And once it falls to 1.166, you'll buy back the euros at a lower price, right? So that difference between this and this in this case, it's about 0.02. So this difference is ultimately just about, the difference here is about 0.02 is the profit you make on this, right? And since it's 100 euros, the profit you would have made on it is $2, okay? Which brings me to my next point. These gains are very small, right? So you've most likely heard of something called leverage in the financial markets, and you'll know that in America, if you live here, the regulation is that we have to trade at about 1 to 50 leverage, and in other countries it can go crazy, 1 to 100, 1 to 200, 1 to 500. Don't get scared about hearing stuff like that. If you have proper risk management, higher leverage sizes are actually very nice, especially for scalp traders that are looking to take 0.5% or 1% position trades on very small pip movements. So for instance, as we get much deeper into this entire concept of trading and how we do it, you'll see that you can be trading on a 1 minute chart and entering very small positions, but you could be risking 0.5% on that small position of like 3 pips, okay? So you'll end up actually risking what appears to be a very large lot size, which is why we trade with leverage. So instead of trading, for instance, 100 euros to dollars, instead of having those 100 euros in our account, we now have 1 to 50 in some cases, right? So it's still not going to be a lot, but it's more. And 1 to 50 in that case would be 50 times 100, which is 5,000. So we'd be trading with 5,000 euros of buying power rather than 100, which means that this 100 euros, which only gives us $2, is now actually going to be worth $10 when we win, if we win this trade right here, right? And as we go on, the more money you have, the more you can make, which is why the idea of financial freedom and finding your way and your success in this market is very prevalent. That's why people want to do it, and that's why some people become very rich and basically go to live the lives they want to live doing this, because they start to understand how they can trade. They start to grow their account exponentially, because once you can compound your account, you're pretty much set, and you can grow it almost nonstop once you have money to grow it with, and once you have a confident strategy you're working with. Okay, so now that we've been over what you're actually trading and the multiple markets you have to trade in terms of currencies, you can also use this on stocks, commodities, whatever it is, but the idea is we're looking at currencies. We're going to switch to a candle chart. Okay, I'm sure a lot of my viewers, seeing as you've seen the institutional order flow videos and you found them somehow through the YouTube algorithm, however it is that it spits it out, or through your searches, you've most likely always already have used candle charts. But for the sake of those that are new, we are going to explain what's going on here rather quickly, because I don't think it takes much explanation. Of course, it looks weird for the first time if you've ever seen this for the first time, but here it is. Ultimately, you have a time frame. Okay, when you go on a time frame, you are looking at ultimately more and more price action, price data. Okay, so if we just zoom out here, you'll see that this is right now. This is the 23rd. Since the market's closed right now, it's Sunday. Market should be opening soon, but right now it's Sunday. So the market closed on the 23rd, which was a Friday. And if we just go back here to the left of our chart, you'll see this is already 2019, right? The idea here is that when we're on a daily chart, each candle here represents 1 day, okay? Since each candle represents 1 day, as you can imagine, this right here is a week, this right here is a week, a month, right? So on and so forth. All of this represents 1 day, okay? When we zoom in, we can talk about what happens during each day based on how a candle looks, okay? So let's, for instance, just single out this candle right here. Right, so we're just looking at this candle right here. We're not looking at any of this stuff to the left. We don't care about it. We don't care about any of this stuff to the right. Okay, the idea of this candle is an up candle, otherwise known as a green one. You'll most likely, if you open a chart on TradingView or something like this, you'll see a bunch of green candles and red candles, which are black for me. Now, a green candle ultimately shows you that during this specific day, or this candle specific, right? So since this is a day, this candle is 1 day. During this day, price made these movements. Price opened at the low of the candle, price closed at this high of the candle, and price during this whole time, these little wicks you see at the very top and bottom, these little things that extend downwards and upwards, were where price went during the time. So price actually went to a high of about this much and to a low of about this much, right? So if we were to think about this day, overall, what you would imagine happened is the price opened here, right? So let's say price opened here. It might have dropped down like this, right? Took off, maybe played around within this area for a while, took off above this high, hitting that high that we've made here, and then ultimately came maybe back down, and at the end of the day, it closed right here, right? So the equivalent of this candle would be seen in this, right? And this is not to say that this is exactly how it would look, right? This price action could have also looked like this. So let's say this was the low, this was the open, this was the close, and this was, and this right here was the high. So the idea is the candle could have done this. It could have opened here, like, because we know this was the open, right? Since the candle started here and closed here. It could have went all the way up here, making that high, came all the way back down, making this low, came back all the way up here and closed, right? Same candle figure, different candle movement throughout the day. The idea is each candle shows you what happens within that candle in terms of price, right? So it's doing is it's showing you what happened during this time and price on a lower time frame. So what I'll show you real quickly is if we jump down back to the candle chart and look at this area right here on a, for instance, daily chart, actually on a 1 hour or 4 hour chart. So let's just do this real quick. We can start to compare and see what happened. Okay, so now we're starting to see a little bit more. Okay, so the price ultimately opened right here, right? So it actually did what we said happened here, right? So price opened at this point. So you see the 12 o'clock, there's a clock at the bottom. Price opened ultimately in and around this area right here. That's that high that it made. I mean, that's that low it made. When it opened, price dropped down, making that low of the day right here. Came up, dropped a little bit more, then took off. As it came higher, it made this high, then came back down, right? And then closed in right here, closing in that low of the day, ultimately right here, right? So during this whole movement here, we actually saw the daily unfold, okay? And by that same token, as we get lower and lower, we're going to see this continue to repeat, right? The idea is when we got to a lower chart just now on the 4-hour chart, so forget about the days we were just looking at and just consider what we're looking at here now, right? We have a same chart of that same euro US dollar, but now every single candle is worth 4 hours. So what you'll notice is this is about a day now. So instead of each candle being 1 day, this is about a day, this is about a day, this is 1 day, this is a day, right? You can see the date on the bottom. So now, even though this was Friday right here, the Friday close, if we go all the way to the left, you'll see that we're still in 2020, and we're just going back till about August, right? So this is about a month of information. This is about 2 months of information right here. So we went from, and we can zoom out, of course, and as you can see, ultimately, if we zoomed far out, this is everything we saw on the daily, just kind of zoomed in on, right? If we go back to the daily, here you have it. We were looking at this area just now on the 4-hour, but zoomed in, because we see all the price action within that price action. Okay, and this continues all the way down fractally as we get lower. We go to the 1-hour chart. Here you go. You see, now if we just zoom out from here, it's the 23rd of October, to here is now the 5th of October. So this is showing you about 20 days, because why? Every candle is 1 hour, right? And if we zoom in, we can tell ourselves a story if we're very new to this. What happened during, let's talk about each candle. What happened? Okay, so this candle, this down one, opened here, maybe came up to make that high. You see that little wick above it? Came up to make that wick, came down to make that wick, and closed. Then the next one opened here. Maybe it came down during this time, came up during this hour, and then closed here. Then so on and so forth. Open here, came down, came up all the way, closed. Open here, came down, came up all the way, closed below. Came here, maybe this one played around for a while. Maybe it came up all the way, then down all the way, then back up to here, right? The idea is there could have been any examples of price movements within any of these candles. The idea is this is how they close and this is what they look like, right? So a lot of people study technical analysis, which we do too, but there's different ways to study it. Some people study in terms of patterns, so looking at things like this, where you have a head and shoulders, where you have a shoulder made, a head, a shoulder, and then you trade it down and you make money off that. Some people trade it in terms of trend lines. Some people put the two together. Sometimes they trade breakouts and support and resistance type things, so they'll see this as a resistance and trade this as support. We don't trade this way at all, but this is what you've most likely seen or been introduced to if you've at all dabbled within the Forex arena. Okay, so ultimately this is what a chart looks like. This is how you read it. These are how the candles look. So we've now gone over the markets we trade, the currencies we trade. We understand they're very liquid. We understand how to read a chart in terms of moving up or down. We understand what it means when we get into a position, for instance, where we sell, right? When we sell, we're anticipating that, what are we anticipating? A lower euro, right? We're selling or buying when we're conducting a transaction, the base currency, so the first currency that shows up within the name. So if we're doing the same thing on something like USD CAD, if we were to buy this, what we're doing is we're anticipating the dollar to get stronger, right? Because we're buying the dollar in reference to the Canadian dollar. So let's get back on the Euro US dollar. Here we go. And now you understand how selling works, and the same thing works for buying. So when you're buying, what you're doing is you're buying the euro, anticipating that the euro is going to get stronger, so you can then sell it later when it's worth more dollars, right? And that transaction is orchestrated through a broker, okay? And brokers can be accessed either online, like Awanda, Forex.com, and other ones like that, or because this is not a broker, right? Itself, it's not a broker. What you would do is you could connect your broker to this, right? So these are a bunch of brokers that TradingView, for instance, offers, which is a charting platform, right? Just like MetaTrader is a charting platform, and things like Forex.com and Awanda use it to conduct operations too. So you can conduct the act of buying and selling through a broker, but this right here on its own is a charting platform. Okay, so the next thing I'm going to go over with you guys is the idea of pips and the measurements of how price moves. So as we understand, when we're looking at this, right, the difference in price, for instance, so like let's say we did take the sell position, okay? The difference in price from here, whoops, my bad, from here to down here is actually, so even though it looks like a big place and we're selling this, and if we get here, like we can make a lot of money doing this, the difference is minuscule, right? So this area right here is 1.18646. So what we're actually going to do is let's put in a line like this so we can actually see the values, and we're selling to, let's say, right here. Okay, so we're selling from 1.18. Let's make it an easy number just for the sake of explanation real quick. So 1.18600 and 1.18100. Okay, so if you really think about the difference between this area and this area, it is, if you just do some normal mathematics, it's 0.00500, right? So the difference from here to here, oops, excuse that crappy drawing, is actually just 0.00500, okay? That's the difference in that currency. So during this hour, even though this looks like a huge drop, that's how much the currency actually changed, which means, as you can imagine, it's to buy a euro, to buy €1, it would just cost an extra, or it would cost $0.0050 less. Okay, and again, this comes back to the idea of why we trade with leverage, right? We traded with leverage because we don't have the money to just dump into this market. What we have is we have a little bit of money, which is magnified into a bigger number through leverage, which allows this number here, this 50 cent, this actually, even less than 50 cent differential. It's about less than even 5 cents. It's 5/10 of a cent. The reason that it's half of a cent. So half of a cent is magnified into bigger numbers when you trade it with more money, right? So you can make money off movements like this. And when a movement like this occurs, this movement right here, when we look at measurements, we say that currency moves in the idea of pips, okay? And pips are ultimately, for most currencies that have 5 decimal places, is kind of the smallest denomination, times 10 in this case. So the idea is this itself would be 50 pips of movement, okay? So you want to look at it as the, from the fourth number, anything to the left of it is the pip movement, right? So if we, for instance, were looking at a drop here, right? Let's say that we had a drop of negative 0.00210, right? If somebody asked you, what's the pip movement of this drop? The answer is it went down, right? 1, 2, 3, 4, then go left, 21. So it's 21 pips. You see that? Right, so you want to move this decimal point 4 times, so multiply by 1,000, and anything to the left is your number, okay? That's all you want to do, times 1,000 if you're looking at anything with 5 decimal places. So by that same scenario, we're just going to do a quick test. If someone says price moved up, let's say 0.02210, right? So that means it went from here to much further up, an increase of 0.02210, and someone asked you how many pips of movement is that, the answer would of course be the same, right? We just move the decimal 1, 2, 3, 4 to here, right? And that movement is 221.0 pips, right? So this is equivalent to 221.0 pips, okay? And just real quickly, by that same token, we're just gonna do one more. Let's say I tell you price moves down 0.00063 points, okay? If it moves down that much, what's the pip movement of this, right? And just real quickly, the reason a pip movement is very important is because in the future, it is what's going to help you predict or use a correct lot size, which is what you use to enter a trade and enter, a certain amount of money into that trade, which will ultimately help you determine, your risk management, your risk to reward, and your future earnings. So back to this real quickly, when I show you this negative 0.00063 number, and I ask you how many pips of movement down is that, what's your answer? Right? Let's move that decimal 1, 2, 3, 4 spots. It's 6.3, right? So this right here is now 6.3 pips, right? And the cool thing is, if you're using TradingView, what you'll notice is if you hold shift and click, okay, this number right here is the pip movement. So a movement from here to here is minus 47.4 pips. Just like if we look at the movement from here to here, right? Just this movement right here is negative 49.7 pips, which is like we said, 50 pips, but we use some easier numbers, right? Just like a movement from, let's say we look at this low to this high, the movement overall, so let's say from the 20th of October at 3 p.m. until 10 p.m. was, right, so we can do this. And see, if you look at the top, nothing actually changes if we do this. This is just so we can see it for ourselves. As you can see, the movement from here to here is 121.5 pips, which is 0.01215, right? We move that decimal 4 times, and we have a pip measurement, okay? So this is the idea of pips, of small movements, and those are important for you later because you are going to use them to determine risk, okay? And now we can get into a little bit of strategy, so we can round off this introductory course with something that can leave you with something to kind of work with, okay? So the idea in this market is you have multiple ways of trading it. There are tons of ways of trading it, and there's tons of people that do different things. There's tons of things that are bad out there. There's tons of things that are great out there. A lot of it comes down to, of course, you've probably heard this risk management and whatnot, but also understanding market movements is one of the most important things in my mind, which is why I have this whole course that I do and all these videos that I do, because I want to teach those that really want to learn, okay? But either way, I'm putting this out there because I want people to have something they can start with, because I didn't really have that, okay? So this was a good introduction to what you can expect in the market, and we're going to quickly jump a little bit further into a little bit harder in the next video, where we're just going to talk about the type of trades that exist, kind of why the market moves, the best starting point, and how you want to go about pursuing learning about this market. Okay, so I hope this was a good introductory video for you to understand why price moves, how it moves up and down, how operations in the financial market is actually transacted, what a candlestick chart looks like, how you are actually trading when you are trading these in the terms of how an intermediary broker works and how a charting software works. This was, again, a very simple video, not aimed at those that are experienced or have been doing this for a while, but this is going to help get a lot of people off the ground and allow them to continue down, for instance, learning through just me rather than having to go out and learn information that I think would maybe be detrimental to them, right? So I hope this was helpful. I look forward to the next time we have a video, and good luck and have a great week, guys.